Hello everyone, welcome to our second part of our discussion having to do with Chapter 4 and the deductions for AGI. So we covered three of them in the first part, and here we are looking at self-employment tax. Now we'll learn a little bit more about this in Chapter 6, but basically when you have your own business, there is a self-employment tax which is basically the same as Social Security, and half of that is counted as a deduction. So you need to know how much your net earnings from self-employment is, and that is how much you made in your business times 0.9365, okay? That's how you calculate it. That's how the form works. So it's not just what you make in the business. You have to adjust for it first. And then you multiply that by 15.3% to get your self-employment tax. And it's half of that is the deduction for AGI on the Schedule 1. So it ends up being 7.65% of that income, right? That's half of 15.3 after you adjust for the net earnings from self-employment. So also along the lines of self-employed, and both of these are to try to put someone who has their own business on the same playing field, you might say, as someone, a big corporation who gets to deduct health insurance, who gets to deduct the cost of their Social Security on their taxes. So it's really trying to put a small business on the same fare in terms of taxes. So this is, if you are self-employed, meaning you have your own business and you're not working for someone else with insurance. So that's the thing. You can't have other insurance. You can't have, because a lot of self-employed people also have a job, right, as well, and they do it, both of them. But if you don't have that, you don't have health insurance through your job, then you can deduct the amount you pay for your family coverage, up to your individual coverage or your family coverage. Okay, that you pay as health insurance. All right. However, it can't be more than you make in your business, right? You can't be paying $10,000 of health insurance and only make $5,000 in your small business. Otherwise, you can't deduct all $10,000. You only deduct the $5,000 up to the amount of your self-employment earnings. So that's probably the hardest limit. And the other one is that you can't have other coverage, right, as we mentioned earlier. All right, and whether if you have your spouse who's working and that they're eligible, okay, then that's not going to that's going to disqualify you from self-employed if it's anyway subsidized. Okay, so then you wouldn't be able to use this deduction. So again, this is for AGI, so it's a good deduction for the health insurance you pay if you're self-employed and don't have health insurance through either your spouse or yourself at work. Now this is pretty uncontroversial and usually a very small amount, so it's not a big deal typically. But the deduction for the penalty on early withdrawal of savings, what happens, you put your money in the bank and in a CD, you agree to leave it in there for a set amount of time, and they agree to pay you interest for that set amount of time. If you need that money early, you pull it out early, okay, then you're going to give back some of that interest. There's going to be a penalty, and that small amount is usually not a big deal, is going to be a deduction here on the Schedule 1 that supports the 1040. All right. And it will be reported. No, you don't have to remember. It generally comes right out of the interest on that CD or whatever other investments you have. Now, little more common and a lot more involved is the concept of alimony, especially since they changed the law. So starting in 2019, if the divorce is finalized in 2019 and later, that alimony is no longer a deduction for AGI, or anywhere for that matter. But if it's prior to that, which there are going to be a lot of people for a long time that have agreements that come from before that time, and they continue to have a deduction for alimony. Okay? And you need to make sure that they haven't made a substantive change to that agreement, okay, since the new rule went into effect. So if they redo their whole alimony agreement, then that could make it no longer deductible. So the key thing is if it qualifies, if it's an old agreement or older agreement, and then it's deductible to one spouse, the one that's paying it, and it's income to the other spouse. So it's a mirror, right? If it's after 2018, then it is not income to the one that receives it, and it's not deductible to the other one. So whichever it qualifies for, it's fair on both sides of the agreement. So when you have a client or something that's paying money to their former spouse, it could be alimony, it could be child support, and it could be a property settlement. Alimony is the one that we're talking about. It has to qualify as alimony to be deductible and included in income. Child support and property settlements are not deductible and are not included. Okay? So it has to properly qualify. It has to be the following, okay? It has to be according to an agreement. There has to be a legal agreement. Payment must be in cash. It has to be required under the provisions. And the payments must end at a payee spouse's death. So if it is to pay, for instance, a mortgage on a house, and that mortgage goes for the next 20 years, that may not qualify because that will go past the end of the life of the spouse. If it were specifically stated that it ends at their death, then it could still be qualified as alimony. So it must be cash, must be required, and it must end at the payee spouse. Now, remember that child support, okay, is not deductible. So if the agreement says you'll pay $2,000 a month until the child is 18, and then you pay $1,000 a month, even though it doesn't say specifically child support, we would look at that as child support for the extra $1,000 that they get up till age 18. And then if it drops, then basically that says the amount of the drop was child support, not alimony. And that, as you can see, is very important to determine which is which. If someone doesn't pay all of their ordered child support, any payments they give, if they're not, say they have child support and alimony that's due, we treat it as child support first. If they didn't pay all that they were ordered, it's always child support up until they've paid all the child support they're required to, and then any additional would be alimony. The other issue is when there is a lot of high payments up front, right after the divorce, maybe in the first couple of years after the divorce, that can often be considered a property settlement, because what happens at divorce is all the property gets, divided up. Well, sometimes one spouse will have assets like a house or some other type of illiquid, hard to sell assets. So it's hard to divide up. They don't want to live together. So they don't want to be sharing the same vacation house. They don't want to be, so how do they do that? And if sometimes to make it fair, one spouse will pay the other spouse instead of cutting the asset in half. Okay, they'll pay him the money difference. That's a property settlement. And we need to make sure that that's not considered alimony, because property settlements are not deductible. Alimony is. So sometimes they might try to sneak in property settlements with high extra alimony in early, and that you'll see the alimony amounts drop after a couple of years. And that might be what's considered a disguised property settlement. And so there's some rules about when they drop too much, that could be a non-deductible property settlement. And that can even be retroactive. That's kind of, you don't want it, the IRS can apply it to old payments a couple of years ago, because they'll look back and say, oh, well, you paid $100,000 in year one, $50,000 in year two, and now you've been paying $30,000 for the last 3 years. We think that extra in the first couple of years was actually a property settlement, and it's not deductible after all. And you have to go back and fix your returns and pay us the interest for trying to cheat. Educator expenses, $250, not a big amount. Okay, for AGI though, so it's valuable in that way. You have to be K-12 educators. You can both use it up to 500, all right, but you can't do 300 from one spouse and 200 from the other. It's got to be up to only 250 total. This is stuff you buy to use in the classroom. Okay, you have to be spending you got to be a full-time teacher. Problem is, a lot of substitutes and things like that aren't going to reach this 900-hour test, and yet they're the ones that often will be buying extra things to bring into class, okay, because they're not sure what the supplies will be there. But if they fit that category, and they're 900 hours is a little less than half time, so it's not too bad. And these are things that you had to buy that the school wasn't going to reimburse you for, okay? And it's got to be common accepted in education fee. It can't be just decoration, things like that, necessary for learning, that sort of thing. Tuition and fees deduction for 2020, $4,000. Now this is for cost. Now this has got, over the years, it's gone away and come back multiple times. But for 2020, it's in place. This is tuition, only fees, not any books, not that kind of stuff. Okay, no housing. $4,000 paid up to, and notice how it phases out. Okay, and it's the same for all filing statuses. The only married filing separate doesn't get it. So this is one of those examples of married filing separate is a bad idea if this is a deduction you want to take advantage of. Notice how this phases out. We saw the student loan interest phase out was gradual, meaning you took a fraction, right? And so if your income was only a little bit over the phase out then you would only lose a small part of the deduction. This is what I refer to as cliff phase out. If your income, okay, hits 130,000, okay, at 130,001, your deduction for this tuition and fees goes from 4,000 down to 2,000. That's bam. If it is over 160,000, it goes from $2,000 to zero. Okay? And that's pretty dramatic. Okay? The other thing you need to remember is whenever you're considering this deduction, there are lots of tax benefits for paying for education. Some others we will learn about in Chapter 9 when we cover credits. Typically, a credit is better than this deduction. And you can't do both for the same costs, okay, or the same student. So you need to evaluate whether this is a better deal for your client or using the credits. All right? And there are multiple credits that you have to consider. So that's the complicating factors.